Hello, and thanks for listening to this week's Fastest 4 Minutes in Finance. I'm Scott Inman. Well, it's all about inflation this week as the Consumer Price Index was released for December. The consensus expectation was that prices would rise 6.5% year over year, and that's exactly what happened. The numbers showed a continuing trend of a cooling inflation rate. Prices were up 7.1% back in November. Better still, the month-to-month pace was negative. Prices in December dropped 0.1% from the month before. Now, behind the headline number, we did see shelter prices rise, energy prices drop, and food prices continued to tick up. Core CPI, which takes out the food and energy, was up 5.7% year over year. Jeffrey Roach, the chief economist for LPL Financial, told us in an interview earlier this week that he expected inflation to come in under 7% for December and that the downward trend should continue into 2023. This is, of course, important because the Federal Reserve is attempting to bring inflation down by raising short-term interest rates with the goal of slowing down demand. That could put downward pressure on prices for goods and services. Roach told us that he believes the single most important piece of economic news or data that could be a catalyst for the stock market this year is the Fed making an announcement that would indicate they are winning the battle against inflation, which would mean the interest rate hikes would soon be over. This inflation data is a step in that direction, but it may take some time before the Fed makes the type of announcement we are looking for. In the short term, it's not a question of if the Federal Reserve raises rates again, but rather by how much. The Fed is expected to increase the short-term borrowing rate either 0.25% or 5% in February. This would at least be a continuation of the slowdown in the sharpness of rate hikes. You may remember they hiked rates by 0.75% 4 straight times before slowing to a half-point hike in December. The Fed forecast suggests they will continue to raise rates until inflation is under control. It's their definition of control that is yet to be determined. Roach told us that he doesn't expect the inflation rate to reach the Fed's preferred rate of 2 to 3% this year. Rather, he expects it to dip possibly to 4% by year's end. Only time will tell if that would be enough for the Fed to stop the rate hikes, which could send the market higher. Thanks for listening.